Hey guys, and welcome to a new video. Today we will be looking at Visa stock, and Visa is a company providing payment services like credit cards and the systems for payment processing from credit cards. Like many of you probably have a Visa or MasterCard credit card. It also has released its earnings reports, which we will be looking at later. So first we look at the chart of Visa. As you can see, it's almost at its all-time high, which means it's probably not at a discount right now. Let's now look at the financial numbers. Market cap is 470 billion, which is pretty high, so it would probably not grow that much anymore. But quarterly revenue is still growing a lot, quarter over quarter. For example, 11% in the last quarter, which is still a good number. So here we can see revenue growth to 30 billion from 15 billion. Also positive income of 14 billion, grown from 6 billion. Shares outstanding has declined from 2.4 billion to 2.1 billion, which is nice. Cash flow from operating activities has risen from 5.5 to 18 billion, 18.8 billion, and free cash flow is almost the same with 17.8 billion, which is also really nice. Total debt is at 22.9 billion and net debt is at 2 billion, so there are not much debt, and they could pay it in 2 years around that area with their net income. And their cash flow is above their net income, which is also really nice. They also pay out a dividend for all of you who want to have a stock which pays out a dividend. It's not that much, around 0.8%, with a payout ratio of 20%. But they could also reinvest it in the company, so it doesn't really matter that much. So now we will calculate the value of Visa. First we'll use my model in this case. Enter the stock ticker of V for Visa. Revenue of 29 billion. Revenue growth of 3% in the lowest case, which is really low in this case. Profit margin of 35%, which is the lowest they had in the recent years, in the last few years. And price to earnings, I would say 15 for the lowest case. But let's go with 10 for a really unlikely case in this case. And we want to make 15% per year, of course. So this would give us a buying price of $19, and the stock is at 230 right now, which would mean it's not a buy, but these are really unlikely numbers. So I would go with more reasonable numbers now. First, 15 PE would give us a buying price of $30. 5% revenue growth would give us a buying price of $35. Profit margin of 40% would give us a buying price of $40, which is more reasonable but still not that high. With revenue growth of 7% per year, we get a buying price of $47, which in this case this is more reasonable to bearish, because I think it has more potential. So now we'll enter the area where it's reasonable. 45% revenue profit margin would give us a buying price of $53. 9% revenue growth would give us a buying price of $64. So now this would be 11% revenue growth, which would give us a buying price of $77. And maybe we'll change the PE to 20. In this case, $103 would be our buying price. So now I want to be very bullish. So we have, in this reasonable case, we have 82 billion in revenue from 32 billion, which is a bit bullish still. But we can, I think Visa can make more revenue than that, to be honest. So the highest profit margin of 50%, which is really high, and 12% revenue growth would give us a buying price of $125. This is a bullish case in this case. 14% revenue growth would give us a buying price of $150, which in this case is still reasonable. I think it would be 107 billion in revenue. It's bullish, but it could happen. It's not that unlikely, to be honest. And now we go really bullish. So this is really at the top, let's say. In this case, We have a price to earnings of 25 and a revenue growth of 16% per year would give us a buying price of $223. You can still go higher, but in this case it would almost 4 times its revenue, more than 4 times its revenue, from 33 billion to 130 billion, around that area. But we can also increase revenue to 17%, which would make it go to $140. And I wouldn't really go above that, which would give us a buying price of $243. So now we'll use the cash flow model. First the ticker symbol of V for Visa. Then cash flow growth of 13% for the first 5 years and 6% for the next 5 years. Our expected return of 15% per year, terminal value of 10 in the lowest case, free cash flow in year 0. So year 0 free cash flow 17.8 billion, stock-based compensation 600 million, net debt is 2 billion and shares outstanding is 2.1 billion. In this case, our buying price would be $117 and we shouldn't buy in this case if we want to make 15% per year. But now we'll put in the terminal value of 15, and in this case the buying price would be $142. But to be honest, you could say that it could be a higher free cash flow if you think the stock will have revenue of 100 billion and 2/3 of it will be the profit margin, will be the free cash flow. Then you would could put higher numbers. In this case you could put 17% and 8%, which would give us a buying price of $177, which is still in this case the stock would be still overvalued. But now let's look at the earnings. So they got higher revenue and earnings per share than expected, which made the stock rise, I think. Yeah. And 8.5 billion in revenue would still be a big jump up from the last few quarters. So this is really nice and would be positive for our bullish outlook on the stock. To be honest, I would wait with buying Visa stock. It's a nice stock, but it's still a bit overpriced. I would wait for it to go around 150 to 200 in that area and buy it there. Maybe even 100 to 200, but I don't think it will go that low, to be honest. So if you enjoyed watching this video, give it a like and subscribe if you haven't already. And if you want to see another video about an interesting stock, Broadcom in this case, you can click on the link right here and watch the video. Bye!